Good afternoon, everyone. I, CS Kushal Kumar, on behalf of ICSI, extend a very warm welcome to the eminent speaker and all participants in the 17th session of EEE 5.0 Master Knowledge Series, which focuses on related party transactions. Before we delve into the topic, we are delighted to announce that the applications are open for the prestigious ICSI National Awards for Excellence in Corporate Governance for the year 2025. This year, we are celebrating the 25th edition of these awards for honoring excellence by recognizing the organization that set benchmarks in corporate governance. Applications are also open for the ICSI Lifetime Achievement Award, ICSI CSR Excellence Awards, and ICSI Business Responsibility and Sustainability Award. For further details about the awards process and categorization, visit the ICSI website. The last day to submit the application is 14th August 2025. Now, coming to the topic of the day, related party transactions, they are a normal feature of present day commercial activities. Apart from unrelated parties, companies do their business activities through various subsidiaries, associates, and joint venture companies, which are treated as related parties. Transactions between related parties may not be made on the same terms as between unrelated parties. RPTs raise important concerns, and hence transparency in such transactions is essential. The law contains detailed compliance and disclosure provisions with respect to RPTs. The restrictions imposed by the Companies Act 2013 as well as SEBI LODR Regulation 2015 are reasonable to avoid a conflict of interest between the company and the related parties. In order to appreciate the nuances of RPTs, it is important to understand the updated provisions of law and the related aspects which may need explanation. Hence, today's session is vital to understand the compliances and best practices for related party transactions. To delve deeper into the topic, we have with us CS Sanjeev Grover, and it's my proud privilege to read his brief profile before our members. He is a fellow member of the Institute of Company Secretaries of India. Presently, he is Executive Officer and Company Secretary of Maruti Suzuki India Limited, having more than 30 years of experience in the field of corporate governance and compliances. His role includes overall supervision, mentoring and guidance of corporate secretarial division complying with various provisions of laws, specifically related party transactions, insider trading, corporate social responsibility, FDI policy, takeover code, incorporation of joint venture subsidiaries, mergers, amalgamations, and many. Since 2020, he is an active member of Secretarial Standard Board constituted by the ICSI. I am confident that today's deliberation will enrich your understanding and equip you with updated knowledge to deal with related party transactions. Once again, I welcome you all and thank you for taking time to join us today. Let's engage, learn, and grow together. Please post your queries, and same will be taken up either at the end of the session or during the session. Now request CS Sanjeev Grover sir to take charge of the session.
Thank you, Kushal, and thank you so much for using so many kind words for me. And I'm just sharing my screen. Just tell me that the screen is visible to all. I think it is visible.
It's fine now.
Thank you. Thank you so much. So, as Kushal has already started and he has already given the context to the topic. But before starting, I would like to make a one disclaimer that the whatever I will be speaking today, these are my personal views, and nothing should be linked directly or indirectly with the company I'm associated with, which is Maruti Suzuki India Limited. As rightly said by Kushal, that the law of related party transactions actually has been made on the premises that either there is a conflict of interest per se, and we can also say that it is on the basis of distrust between the shareholders and the management which is looking after the companies. So the contents of the today's presentation would be, let us once again discuss what exactly is the definition of related party and of course the related party transactions, the concept of material related party transactions, approvals for related party transactions, be it through audit committee, the board, and of course the shareholders. And I would also touch upon the one of the transactions which Maruti entered into in 2015 when the law was very new, and there was a big transaction between Maruti and one of the subsidiaries of its promoters for contract manufacturing agreement, where the vehicles were manufactured by that subsidiary and it was, given to Maruti on no profit, no loss basis. The new industry standards, which have just come recently, and there were some changes, and now which are going to be effective from 1st September 2025. And also, I will just touch upon the draft consultation paper by SEBI, which has been given which has been circulated by SEBI a day before yesterday. So these will be the contents of my presentation today. So if we see the definition of related parties under the Companies Act, because the definition is different as far as the Companies Act is concerned and also the listing regulations. The related parties as defined under the Companies Act includes the director or his relative, KMP or his relative, a firm in which a director, manager or his relative is a partner, a private company in which a director or manager or his relative is a member or director, a public company in which a director or manager is a director and holds along with his relatives at least 2% of its paid up share capital, any body corporate whose board of directors, managing director or manager is accustomed to act in accordance with the advice, directions or instructions of a director or manager, any person on whose advice, directions or instructions a director or manager is accustomed to act. However, any advice which is given on professional basis, in that case, nothing in clause 6 and 7 shall be applicable. So in that case, if the advice is on professional nature, then that body corporate or a person on whose advice it has been given, that will not be taken as a related party. However, if you see the point number 3 here, I would just like to, highlight, we are talking about a firm in which a director, manager or his relative is a partner. Though if you see the point number 2, where, the KMP or his relative is also a related party. However, I don't know why, as far as the firm is concerned, the law has not captured that a firm in which KMP or his relative is also a partner, then that firm will also be a related party. So though by implication, what is the meaning of this clause is that the company cannot enter into a transaction with a firm in which director, manager or his relative is a partner, without taking the approval of the audit committee. But if there is a firm in which KMP or his relative is a partner and that firm is not a related party, you can enter into a related party transaction with that firm. Maybe I think there is a miss or something which, the law has not captured rightly. But according to me, the KMP or relative, if they are the partner in a firm, that should also be captured. And not only for this is, I'm talking about the Companies Act, but now if you see the definition of the senior management personnel under the listing regulations, I think somewhere those people should also be considered while defining the related parties. Going further, the definition also talks about that the related party includes a company which is a holding subsidiary or an associate company of such company. As you know, the associate company means a company in which the company has a significant influence, that is more than 20% of the capital. A subsidiary of a holding company to which it is also a separate subsidiary means the two sister concerns of their father is same, so they will also be termed as the related parties, and any transaction between these two companies will also be termed as related party transactions. Then it also talks about an investing company or venturer company, meaning thereby if an investing company has invested at least 20% of its in the capital of a company, then that investing company or venturer company shall also become a related party as far as the main company is concerned. It not only talks about the director of the company, but it also talks about the director or KMP of the holding company or his relative with reference to that company, and that director or KMP of the holding company shall also be deemed to be a related party. However, they have exempted the independent directors of the holding company. So the independent directors of a holding company will not be termed as a related party, or any transaction with those directors does not come under the purview of related party transactions. Now, these were the definition of related party under the Companies Act. But if we talk about the definition of related parties under the listing regulations, so there it covers whatever has been defined under the Companies Act. In addition, thereto, the definition of related parties under Accounting Standard 24. So any party which is covered there, that shall also be deemed as a related party under the listing regulations. Then any person or entity forming part of the promoter or promoter group of the listed entity. I will touch upon a very interesting case in this slide itself, and let me come to that. Then further, any person or an entity holding equity shares of 10% or more in the listed entity, either directly or as per Section 89, if there is a beneficial interest, that person or entity shall also be deemed to be a related party of the listed entity. Now, suppose we take an example of Life Insurance Corporation, and suppose LIC is holding more than 10% in my company, which is a listed company. So by this clause, LIC will also become my related party. So the question comes, when I take the insurance policies of my employees from LIC, do I need to take the approval of the audit committee? The answer is yes. Though it's a very unique kind of a case that, the LIC will be giving the, taking the insurance premium on the same basis from the public at large also. And also when I will be taking the insurance policies for my employees, I have to take the approval of my audit committee, and also to justify that these insurance policies and the premium which I'm giving, it is on arm's length basis, means it is on market rates. Now, as I was telling that, any person or entity forming part of the promoter or promoter group of a listed entity, that also becomes a related party. I'm just taking an example that if suppose there are two companies, A Limited and B Limited, and both are listed companies, can we say that, and suppose A Limited belongs to the promoter group of B Limited, then it means, as clause number 3 on this screen, which says that any person or entity forming part of the promoter or promoter group shall be a related party. So it means the A Limited is a related party of B Limited. However, if we see whether vice versa is true or not, so can we say that though A Limited is a related party of B Limited, but whether B Limited is also a related party of A Limited or not? Let us assume that though A Limited belongs to the promoter group of B Limited, but B Limited does not belong to the promoter group of A Limited. Hence, in this case, B Limited shall not be a related party of A Limited. So what will be the impact in such a case? That while taking an approval of material related party transactions in case of A, when A will go to its shareholders, B Limited shall not take the approval of its minority shareholders, whereas A Limited shall not participate. However, A Limited is not required to take the approval of its shareholders for such transaction, as B Limited is not its related party. So meaning thereby that there may be instances where one party is a related party of the other, but the other party is not a related party of the first company. Now, what is the related party transactions? And interestingly, as you are aware that the related party transaction has not been defined under the Companies Act. There are only 6 kinds of transactions which have been mentioned under Section 188. However, nowhere the definition of related party transaction has been given under the companies, though it is different for the listing regulations, which is the related party transaction has been defined. And as far as the approval process is concerned, we know that all the related party transactions and their subsequent modifications are to be approved by the audit committee. However, taking the problems which the companies were facing earlier, SEBI, they made some changes in the listing regulations, and according to now the regulation 23, not every modification is required to be approved by the audit committee under the listing regulations. It says that only the material modifications are required to be approved. However, it doesn't make any change as far as the Companies Act is concerned. So by making the changes in the listing regulations, the companies, they have to go to the audit committee for all the transactions, because 177 requires that every modification is required to be approved by the audit committee. Now there is a concept of omnibus approval, where certain things which are not known to the management as such. However, since audit committee cannot sit all the time for giving the approvals, and some the need is foreseen for entering into that transaction during the year, so the audit committee can give the omnibus approval for those transactions. However, under the policy on related party transactions, the audit committee has to define and give the reference under which circumstances this omnibus approval can be given. Some of the examples are that what exactly should be the maximum value of the transaction in aggregate, which the audit committee can approve. What is the maximum value per transaction, which is going to happen in that financial year? What disclosures are to be made to the audit committee at the time of taking the omnibus approval? Periodic review of such transactions, whether quarterly or half-yearly. Transactions which can be done through omnibus approvals, the examples can also be given in the policy. What is whether the transaction is repetitive in nature? What is the justification and what is the need of that transaction which is required to be entered by the company? Name of the related parties, and nature and duration of the transaction. So after giving all these particulars to the audit committee, the company can take an omnibus approval for that financial year from the audit committee and enter into those transactions. However, where need is not foreseen and above details are not available, then Section 177 states that the omnibus approval cannot exceed 1 crore per transaction in one financial year. No omnibus approval for disposal of undertaking. So the omnibus approval can be given for sale and purchase of goods or services, lease, and other transactions. But the omnibus approval cannot be taken from the audit committee as far as if the nature of the transaction is disposal of undertaking. Now it is very interesting to note that in case of a transaction other than transactions referred to in Section 188, which is that the sale and purchase of goods or lease or other transactions which have been mentioned in 188, and where audit committee does not approve the transaction, it shall make its recommendation to the board. Now, if we see section 188, it talks about only 6 types of transactions. So when we read 188, it looks that the power under the Companies Act has been given to the board to approve only those 6 kinds of transactions, like sale, purchase, selling or otherwise disposing of or buying property, leasing of property, rendering of services, appointment of any agent for purchase or sale of goods, then office or place of profit, and underwriting the subscription of any securities. Now, when 177 states itself that for the transactions which are not referred in section 188, and if the audit committee does not approve that transaction, it shall make its recommendation to the board, then indirectly and by implication, it states that all the transactions are actually required to be approved by the board also if the transaction is either not in the ordinary course of business or not on arm's length. So if there is a transaction which is other than the nature in 188 and it is not on arm's length, and the audit committee states that it should be recommended to the board, then the board has to take a view whether the company should enter into that transaction or not. Let us also discuss, the related provision which is given under 177, and which requires that if we, see whether are the transactions between a holding company and its wholly owned subsidiary companies exempt from approval of the audit committee under section 177 or not. So the question is whether all the transactions between holding company and its wholly owned subsidiary are exempt from taking an approval from the audit committee under 177 or not. So proviso 4 of section 177 4 states that the provisions of this clause shall not apply to a transaction other than a transaction referred to in section 188 between a holding company and its wholly owned subsidiary companies, meaning thereby that the transactions which have been mentioned in section 188, those 6 kinds of transactions, there is no exemption if that transaction is entered between a holding company and its subsidiary company. So the approval of the audit committee for those transactions has to be taken from the audit committee. The exemption has been given only to the transactions which are not referred under section 188. For example, providing a guarantee or giving a guarantee on behalf of a subsidiary for a loan which the subsidiary is taking from the bank. Since the guarantee is not mentioned in section 188, then if the holding company is giving the guarantee on behalf of its wholly owned subsidiary, then the approval of the audit committee is not required. So the transactions other than specified under section 188 are exempt, and no approval of the audit committee is required in that case. Now we come to the approval mechanism. As we have already touched upon the approval of the audit committee. Apart from the audit committee, when do we need the approval of the board of directors? So under 188, as you know that all the transactions which are either not on arm's length or not in the ordinary course of business, we need to take those transactions to the board of directors. And all the transactions which are, above the threshold, which are given under Rule 15 of Section 188, those transactions are required to be taken to the shareholders for approval. For example, in case of sale, purchase or supply of any goods, leasing of property, availing or rendering of any services, directly or through appointment of agent, if the value of that transaction is more than 10% or more of the turnover of the company, and also the transaction, for example, is not on arm's length or it is not in the ordinary course of business, then we need to take the approval of the shareholders also. Another thing which is mentioned in 188 is selling or otherwise disposing of or buying property of any kind directly or through appointment of agent. Then the approval of the shareholders is required if the value of the transaction is 10% or more of the net worth of the company. So in the first three instances, we need to take the approval of the shareholders when the value is more than 10% of the turnover. And in this case, which is the disposing of the property, then the 10% or more of the net worth of the company is the requirement. Appointment of any office of place of profit if the remuneration is more than 2.5 lakh per month, and remuneration for underwriting the subscription of any securities or derivatives of the company, which is more than 1% of the net worth of the company. So in all these cases, apart from taking the approval of the audit committee, we need to take the approval of the board and also the shareholders, provided these transactions are not on arm's length or not in the ordinary course of business. Now, following points are required to be considered while taking the approval of the shareholders: that the no related party who is a member shall vote in favor of the resolution in the general meeting. So meaning thereby they can vote, however, they will not vote in favor. They can vote against the resolution which is being put up before the shareholders. No shareholders approval is required for a transaction between the holding and its wholly owned subsidiary if the accounts of the subsidiary are consolidated with that of the holding and placed before the shareholders in general meeting for approval. So in case of a holding and wholly owned subsidiary, no approval of the shareholders is required. Now, related party transactions approved under section 188 are to be reported in the board's report, as you know, under form AOC2. And not only the transactions which are not on the arm's length, but the material related party transactions are also to be mentioned in form AOC2, which becomes part of the board's report. Now we are coming to the related party transactions under listing regulations. Now, as I have already said that there is no definition of related party transactions under the Companies Act. However, under the listing regulations, the RPT has been defined and the definition has been taken from the accounting standards. And it says that the transaction involving a transfer of resources, services, or obligations between a listed entity or any of its subsidiaries on one hand, and a related party of the listed entity or any of its subsidiaries on the other hand. So interestingly, if there is a transaction where the listed entity is not a party and the transaction is between its subsidiary and also the related party of the subsidiary or the related party of the listed entity, even then that transaction becomes a related party transaction for the listed entity. Then it also says that if a transaction is between a listed entity or any of its subsidiaries on one hand and any other person or entity on the other hand, the purpose and effect of which is to benefit a related party of the listed entity or any of its subsidiaries. So in this case, the transaction is not with the related party itself, but with an unrelated party. However, if the benefit accrues to the related party of the listed entity or any of its subsidiaries, even then it becomes a related party transaction for a listed company. And of course, whether the price is charged or not, if a transaction is given in a contract and nothing is being charged there, even then the transaction becomes a related party transaction. However, I don't know whether this definition has been given in the listing regulations that nothing is charged here, because as far as the materiality is concerned, we have to see the pecuniary relation between the related parties. However, following transactions are exempt from the purview of related party transactions under the listing regulations. One is the issue of shares on preferential basis, then the payment of dividend, subdivision or consolidation of securities, issuance of securities by a right issue or a bonus issue, buyback of securities. So these are exempt. Now let us see through this diagram what we have already discussed so far, that what are the transactions which are related party transactions under the Companies Act, and what is the approval which is required. So under the Companies Act, any transaction undertaken with related parties, which is in the nature of transactions covered under Section 188, and all transactions covered under Section 177 requires the approval. However, as per the listing regulations, the transaction involving a transfer of resources, services, or obligations between listed company and its subsidiary, between related party and related party of subsidiary, then listed company and related party of listed company, subsidiary company and related party of subsidiary, even listed company and related party of subsidiary, and subsidiary and related party of listed. So all these combination of transactions are related party transactions for the listed company under the listing regulations. And also, as we have touched upon, any transaction between listed company or related party of listed company, or subsidiary or related party of subsidiary company with a unrelated party, where the benefit of the related is going to the related party of listed company or subsidiary company, that will also be counted as a related party transaction for the listed company. Now going forward, as I was telling you about this was the first transaction after the coming out of the Section 188 under the Companies Act. In 2015, Maruti entered into a related party transaction with respect to the contract manufacturing agreement with Suzuki Motor Gujarat. And Suzuki Motor Gujarat was the wholly owned subsidiary of, or rather is a wholly owned subsidiary of Suzuki Motor Corporation. And the transaction was the contract manufacturing, that is the manufacturing of vehicles by Suzuki Motor Gujarat, and exclusively supplying this to Maruti Suzuki India Limited. And the consideration was nil. There was no profit, no loss. I'm not saying that the consideration was nil, but there was no profit involved in that. Since there was no profit, it was not on arm's length, and Maruti and SMG were the subsidiaries of Suzuki Motor Corporation. We had to go not only to the audit committee for approval, but also to the board and also to the shareholders. So I would just request all the participants, they can look for the postal ballot notice, which is on the website and also there on the website of the stock exchanges. Just go through that postal ballot, and there is kind of information which I think the participants should go through. Now coming to the material related party transactions under Regulation 23 of listing regulations. It states that the company is required to formulate a policy on materiality of related party transactions, and this policy has to be approved by the audit committee and also by the board, and it has to be reviewed by the board of directors at least once in 3 years and updated accordingly. Now, what is the materiality under the listing regulations? That it talks about any transaction which is more than 1,000 crore or 10% of the annual consolidated turnover of the listed entity as per the last audited financial statements of the listed entity. So in this case, we need to have the approval of the shareholders. And mind it that in case of listing regulations, the listing regulations talks about only about the justification. It doesn't talk about whether the transaction is on arm's length or not. The arm's length, the perspective has been given in the Companies Act only and the accounting standards, where we need the approval of the audit committee. However, as far as the listing regulations is concerned, they talk about the materiality, and they say that if the transaction is more than 1,000 crore or more than 10% of the annual consolidated turnover, then we need to justify that before taking the approval of the shareholders. Now, there is a very interesting case which is going on between Linde India, which is a Calcutta-based company, versus SEBI. And in this case, the SEBI has taken a view, the assessing officer, that all the transactions with one related party are to be added together. If the sum total of all these transactions is more than 1,000 crore, then all the transactions become material transactions, and the company has to take the approval of the shareholders. Now, suppose there is a transaction of 990 crores for supply of goods. Since it is less than 1,000 crore, it is not a material transaction. However, there is a transaction, another transaction, which is of, say, 11 crores of provision of services also. And the sum total of these two transactions, which is the sale of goods of 990 crores and provision of services of 11 crores, which becomes more than 1,000 crore, which is 1,001 crore, then the company is required to take the approval of the shareholders. Though Linde India has given all the opinions which have been taken from not less than the Mr. Abhishek Manu Singhvi and the retired Supreme Court judges. But however, the assessing officer has taken a view that all the transactions are to be added. However, somewhere it is not matching with the definition of the related party transactions, which has been taken from the accounting standard, which states that the supply of services, obligations, etc. And when this definition was taken from the accounting standard requires, the disclosure of the transactions actually separately in the notes to the balance sheet. It doesn't say that all the transactions should be added. It says that even the sale of goods to be shown separately, purchase of goods should be shown separately in the notes, supply of services should be shown separately. But however, before this case, which is the Linde India case, many companies, listed companies, were taking that the materiality should be linked with the class of transaction. So if one class of transactions, say the supply of goods, is worth more than 1,000 crore, only then it is required to take the shareholders' approval. However, as far as after this case, which is still with the SEBI Appellate Tribunal, the final judgment has not come. The most of the companies have started taking the approval of the shareholders by the adding all the transactions. However, another problem which we see while taking the approval from the shareholders is with the proxy advisors. As the example which I have taken, the 990 crores and 11 crores, while going to the shareholders, the proxy advisors sometimes take a view that when you add these transactions, it is not a specific transaction, it is a omnibus transaction, because you have added two class of transactions together. So since it is a omnibus approval, we will not give you approval for more than 1 year, which is required under the listing regulations. So there are so many problems which are attached with these material related party transactions, and the justification we have to give not only to the shareholders but the involved proxy advisors, and it has become little difficult for the listed companies. Now coming to as far as we have touched upon that 1,000 crore or 10% limit for the materiality clause. However, there is another clause in Regulation 23, which is a non-obstante clause, which starts with that notwithstanding anything contained above. So this talks about the payment of royalty. So in case of royalty payment, the limit of 1,000 crore is not applicable. It talks about only the 5% of the annual consolidated turnover of the listed entity. So meaning thereby, even if the payment of royalty is more than 1,000 crore, But if it is less than 5% of the annual consolidated turnover, then it doesn't become a material related party transaction, which is now I'm touching upon this screen by taking an example, which is a very important thing, as far as for the listed companies who pay, you know, the material amount to their foreign collaborators, to their promoters in terms of the royalty by taking the technology transfer from outside India. Now, suppose there is a listed company which pays a royalty of 2000 crores in 2022-2023 to its related party. So does it require approval of the shareholders? As I have already said that materiality of 1000 crore is not applicable in case of payment of royalty. So if this amount of 2000 crore does not exceed 5% of the consolidated turnover, then the approval of the shareholders is not required. So I have taken the example of 2000 crore. However, even if the amount is 5000 crore or 10,000 crore, etc., but if it is less than 5% of the consolidated turnover, no approval of the shareholders is required. Though in the new consultation paper, the materiality clause, the SEBI has come out with a very good, the this consultation paper, and they have given some new slabs, and that 1000 crore limit shall not be applicable. That will I will touch upon in the the last slide of my presentation. Now, as far as the material related party transactions are concerned, as I have already said, that all related party transaction and subsequent material modifications require prior approval of the audit committee, provided that the members of the audit committee who are not independent directors, they will not participate in the discussions. Also, there is another interesting provision that the related party transaction where the subsidiary is involved, but the listed entity is not part of that related party transaction, and the amount is exceeding 10% of the annual standalone turnover of the subsidiary company, then that transaction becomes you know, requires an approval of the audit committee of the listed company also. Now, interestingly, suppose if we take an example that a subsidiary company is entering into a transaction with its related party worth more than 1000 crore. So when it exceeds 1000 crore, it becomes material RPT, and we need to take an approval of the listed entity or from its shareholders. However, if it is less than 10% of the annual standalone turnover of the subsidiary company, it does not require the approval of the audit committee. So it's a very interesting case where no approval of the audit committee is required. However, the approval of the shareholders of the listed entity is required in such a case. Now, touching upon the some of the scenarios. Suppose, for example, there is an agreement between two subsidiaries of a foreign body corporate for manufacturing of bikes, where one of the subsidiaries is a listed entity. Does it require shareholders' approval under the Companies Act and listing regulations? Assuming it is on arm's length. If suppose it is on arm's length, then under the Companies Act, no approval of the shareholders is required. However, even if it is on arm's length, but the transaction is worth more than 1000 crore, yes, we need the approval of the shareholders. Now, assuming that it is not on arm's length, under the Companies Act, we need the approval of the shareholders, provided the transaction is exceeding the 15% of the turnover or the 10% of the net worth, as the case may be, as has been given in the Rule 15. Now, another interesting point here is that I have touched upon that in case of the listing regulations, if company A is not a promoter group or belong to promoter group of company B, then in that case, the company A and company B may not be related parties to each other. Similarly, in section 276, there may be a situation where that there is a common director between company A and company B who holds more than 2% of the equity of company B only. So in such case also, though A and B, the common director of A and B holds more than 2% in B only, hence B will be a related party of A. However, common director, since he does not hold more than 2% of the equity of company A, he will not be A is not a related party of B. So in this case also, it is not true that if a company A, one company has become a related party of another company, then the vice versa will also be true. Now let us take another example where the company A Limited sells a product in the market for rupees 400 per unit, and it also sells the same to its associate company at the same price, everything is same. However, the credit period given to unrelated parties 3 months, whereas the same is 6 months for associate company. So the question is the transaction on arm's length? So not only the price, but all the terms and conditions should be on arm's length. So in such a case where the 6 months, the credit period has been given to the associate company, then this transaction will not be termed as that this transaction is on arm's length. Will a preferential allotment of shares to a related party will be treated as related party transaction? Though we need to take the approval under section 42 and 62 and also under the the preferential allotment guidelines of SEBI, but the same is not a related party transaction as has been clarified by SEBI, and also under the Companies Act, it will not be termed as related party transaction. Now coming to the new standards which are going to be applicable from 1st September 2025 now. As you know that SEBI issued a circular on 14th February 25. Initially, the circular was applicable with effect from 1st April 25, where some minimum information is required to be placed before the audit committee and shareholders in case the transaction is material. However, on receipt of feedback from various stakeholders, the applicability of this industry note standards was extended to 1st July 25, and further on request, now it has been shifted to 1st September 25. What exactly is these industry standards is? First of all, that these standards, there is no change in the definition of related parties. There is no change in the definition of related party transactions. This circular prescribes only the minimum information which is required to be placed before the audit committee and the shareholders for approval. Following transactions are exempt from these standards: the transactions with wholly owned subsidiary, quarterly review of RPTs by the audit committee where the omnibus approval has been taken, so that review is not required for these standards. RPTs which are less than 1 crore with one related party in a financial year. So in such transaction also, these minimum standards are not applicable. What is the difference between the old standards and the new? If you see in the old standards, the disclosures were categorized into 3 categories: comprehensive disclosures, which were applicable where material RPTs are concerned. So comprehensive disclosures were required to be given for material RPTs. Minimum disclosures were required for the RPTs with promoter and promoter group. This category of RPTs with promoter and promoter group has been removed now, and limited disclosures were required for the RPTs other than material and promoter group. Now there are only 2 types of transactions and the disclosures in the new standards. The part A, which is applicable for every related party transaction, which is the minimum information like basic details, relationship between the parties, ownership of the related party, what is the amount involved, etc. Then in the part B, they have defined 7 types of transactions like sale, purchase of goods, loans, advances, guarantees, borrowings, sale of assets, subsidiary and royalty. So in addition to the information which is required under Part A, that the additional information is required in Part B, which is about the bidding process or the royalty which has been taken by the promoter from other the other related parties, not in India but also outside India. Then in Part C, which is applicable for material RPTs, in addition to Part A and Part B, this Part C information is also required to be placed before the audit committee and the shareholders. And important change as far as the certificate from CEO is concerned. Under the old standard, if you see, the certificate was required to be obtained from CEO or CFO or any KMP and also from every director who is a promoter of the company. And the certificate required to mention that the related party transaction is not prejudicial to the interest of the public shareholders, and the terms and conditions of the RPTs are not unfavorable to the listed entity compared to the terms and conditions had similar transactions been entered into with an unrelated party. So there were two points which were to be covered, and it was little bit in the negative sense as far as that certificate was concerned, and it was required to be obtained from CEO or CFO. CFO was not compulsory at that point of time. However, in the new standards, now this certificate is required from CEO or MD or WTD or manager and from CFO. From CFO is now it is must, and it is to be mentioned in the certificate that the terms of RPTs are in the interest of the listed entity. So it is actually some provisions of those standards have been diluted. It is good for the ease of doing business. It would be easy to get the certificate now rather than the earlier standards. Now coming to the last slide of today's session, which is this draft consultation paper has been issued by SEBI on 4th of August only. So if you say the for material RPTs earlier, we require to take the approval as we have already seen for a transaction worth more than 1000 crore. Now, different buckets have been defined by SEBI based upon the consolidated turnover of the listed entity. So if the consolidated turnover is up to 20,000 crore, then 10% of the annual consolidated turnover will be the materiality threshold. So in this case, if the turnover is 20,000 crore, so the threshold will be 2,000 crore. So if the any transaction which is worth more than 2,000 crores, only then it will require shareholders approval. Now, if the consolidated turnover is in between 20,001 and 40,000 crore, then for the first 20,000 crore, that 2,000 crore limit is there. And for the rest of the 20,000 crore, rather than 10%, it would be 5% of the balance amount. So the total amount would be 3,000 crore in this case. So any transaction which is more than 3,000 crore with a related party, then we need to have a approval of the shareholders. Now, if it is more than 40,000 crore, so it would be 3,000 and 2.5% of the rest amount. And the maximum amount which has been mentioned is 5,000 crore. So if it is more than 5,000 crore, then the limit will be taken as 5,000 crore, means whichever is lower. So the following illustrations have also been given in the consultation paper, like if the turnover is 30,000 crore, then the materiality would be 2,500. If it is 50,000 crore, it is 3,250. And suppose the turnover is 1,50,000 crore, like in our case, in our company's case, it is 1,50,000 crore, then the limit might be for that, if we calculate under this formula, it comes out to be 5,750 crore. However, the limit has been mentioned as 5,000 crore. Since it is more than 5,000 crore, we need to take the approval of the shareholders under material RPT. So this is going to be the change which is coming now. I think SEBI will be taking it after taking the inputs from all the stakeholders. The last date of giving the inputs is 25th August. And I think in the board meeting of SEBI, which is scheduled in September, these changes will also take place. Along with these changes, there are many other changes with respect to RPT, like, the transaction of the subsidiary with its related parties, which I mentioned that if it is more than 10%, then only the audit committee approval is required. However, now they have linked that approval of the audit committee with this bucket, which is coming which is appearing on the screen. That change is also there. So many changes have been given by SEBI now. It is a welcome step. I think many transactions of the big listed companies will not be required to take approval of the shareholders in such a case. So that's it. Thank you so much for patient listening, and thanks once again. Over to you, Kushal. Any questions? Then we can.
Yes, sir. Thank you, sir, for the session. So, with your permission, let's take the questions now, sir.
Sure.
Question number one is whether following are RPT transactions. First, remuneration to managing director and whole-time director.
Very, very good question. Actually, if you see the regulation 23, what the regulation has now said is that in case of sitting fees and the remuneration of directors and KMPs, it is not required to be disclosed to the stock exchanges on 6 monthly basis, which we, give the disclosure to stock exchanges, unless it is material in nature. So by implication, it is not required to be disclosed, but however, on a conservative side, by taking both the provisions under the Companies Act and also the listing regulations, we should take an approval from the audit committee. It should be termed as a related party transaction, but it doesn't require disclosure to the stock exchanges because it is not material in nature.
So fixed monthly payments to directors for their professional services.
So as I said that the professional services are actually not termed as, the related party transactions. However, maybe again, since it is a transfer of resources from the listed company to your related party, I think the approval should be taken from the audit committee, and not only from the audit committee. I think we have to see whether we need the approval of the nomination and remuneration committee also under the NR policy. So that the companies have to, or the participant have to see that policy also.
So loans from directors and payment of interest thereon.
So loans from director, it is a related party transaction. Very much.
So loans, investment and business transaction with wholly owned subsidiary.
As I have already touched upon the wholly owned subsidiary case, if it is not in the nature of, the section 188 transactions. So any other transaction, though it will be termed as the related party transaction, but we don't need the approval of the audit committee in that case. So if it is falling under the nature or the transactions which are given in 188, then we have to take the audit committee approval. So in other cases, though we don't need to take the audit committee approval, but it is a related party transaction, because otherwise, who will see whether these transactions are on arm's length or not on arm's length? So per se, the law has not said that if any transaction between the holding company and the wholly owned subsidiary companies, they are not to be seen by the management, whether it is on arm's length or not. But only thing is whether we need the audit committee approval or not. So, to repeat myself once again, if it falls under 188, then we need to have the approval of the audit committee. If it doesn't fall under 188, there is no need of taking the audit committee approval.
So moving to question number 2, which is a situation-based question. A society registered under Society Act has 3 members, and those 3 members are directors and shareholders in a private company. That private company does major business with that entity registered as society, that is non-profit organization.
Mhm.
Since Section 188 does not cover any transaction with NGO, where the directors are common members of society as RPT, can we say that Section 188 is not applicable?
See that I think it is, we have to go into the details of this transaction. Will be difficult to comment upon it, right now. However, let me, also touch upon, just see the definition of the body corporate also. Because when you see the applicability of related party transaction, it is not applicable in case of a, when there is a body corporate, whether the society comes under the body corporate or not body corporate. And then they have taken that it is, the transaction is between that society and the private company. And in case of a private company, whether the audit committee, the constitution of audit committee is there or not. I don't know whether what is the paid up capital of that private company or turnover, etc. However, at the same time, as far as the governance point of view, if we have to see any transaction with any, where there is a conflict of interest, how to find out whether, this transaction is on arm's length or not. Not only from the perspective of the Companies Act or the accounting standard, I think in the balance sheet also the auditors have to comment the transactions, all the transactions with the related parties are on arm's length or not arm's length. So, per se, we don't have to see only the Companies Act. We have to see from the angle of, the whether there is any conflict of interest or not. We don't have to come out, we can do any transaction with anybody if it is not being covered or there is a gray area. So from that angle, I think we have to see. You can just send me this, the problem. Let me go through it in detail. Only then I can comment upon this.
Okay, sir.
Yeah.
We'll do that. So shall we go for the next question?
Yeah, please.
A. Japan Corporation is the parent. B. Indian company is a wholly owned subsidiary of A. A sold its business to C, the Chinese company.
A is a Indian company.
A. Japan
Okay.
Corporation.
Okay, Japan Corporation, fine.
B. Indian company is a wholly owned subsidiary of A.
Okay.
A sold its business to C, a company from China. However, the shares were not transferred to C due to the PN3 restrictions. Now, C is managing partly B company.
C is managing company. Which
C is
company?
managing partly B company.
Okay.
C having one executive position below the director level appointed as a non-executive director in B companies. Shall C as the related party of B? On which grounds?
Send me this, Kushal. Otherwise, I will be termed as a,
sir.
very big consultant, or even if you want to take a legal advice on this, the legal consultant will take at least one week for this. Just send me these kinds of, the problems. I won't be able to comment on
problem-based
this.
question will send you, sir.
Yeah.
Sir, next question is it possible to take shareholder approval for more than 1 year through single resolution for material RPT in AGM, other than omnibus approval, when the nature of transactions and party of transaction are same every year, just the amount is different?
Yes. They can take, I think they can take my example also. Whoever has, asked this question, just go through my postal ballot, which we have taken the approval this February only, and also the approval which we have taken in the AGM of 2022. We have always taken the approval for 3 years from the shareholders. Normally, practice by the proxy advisors is that they don't give the approval for up to 5 years. However, the situation is same in my case also. The related parties are same. The transaction is same, only the amount differs every 3 years based upon the expansion of the business. Yes, you can take an approval for more than 1 year if it is a specific transaction. It should not be omnibus.
Yes, sir. Sir, if a JV company issue equity shares to JV corporate body partner as a right issue, and the amount is more than the existing paid up capital and reserve, and the company has not completed its 1 year, and the accounts are unaudited, the transaction shall be treated as related party transaction or no?
See, under the listing regulations, they have given now the exemption. Earlier, we were treating it as a related party transaction. However, I think I have touched upon this aspect also in one of my the slide in my presentation, that the right issue and the bonus issues, etc., they have been exempted under the listing regulations. However, from the point of view of the Companies Act, some companies are taking a conservative view that it may amount to the related party transactions, but some companies are not. But I think this can be exempted. There is no need of taking the approval in such a case.
Okay, sir. Moving to the next question. Suppose an RPT is being entered between holding and subsidiary, both
Mhm.
being private companies, not
Mhm.
considered as related party as per exemption notification, but
Mhm.
have common directors. Can
Mhm.
the exemption be still availed?
Yes, yes, it can be availed.
As per minimum information standards, minimum information is to be provided to the audit committee or shareholders. If
Mm.
the minimum information approved by audit committee is approved, should it require shareholders approval even if it is less than 10% of the turnover?
Not required. See, shareholder approval will come into picture only when either it is more than 10% or it is more than 1,000 crore. Otherwise, it is not required.
Okay, sir. So in case of all intra-group companies transaction, how we will set arm's length price?
See, just a minute, Kushal. Just there is a phone call from my chairman. Just yeah, Kushal. Sorry for that. Can you repeat the question, please?
Yes. So in case of all intra-group companies transaction,
Hmm.
how we will set arm's length price?
Yeah. See, there are many methods in such a case. One interesting method is the net margin profitability. Like, even if we take an example where the bidding is not possible, right? I'm taking something from my intra-group companies, say, from my holding company, which is not based in India, but it is based in Japan or somewhere else. And there is no comparative prices are available in India. So we have to take the comparison of the profitability of the other companies in India, which are into the same business. For example, in Maruti, we can take the example of Mahindra and Mahindra, and we can take the example of Tata Motors also as far as their profitability is concerned, as far as the nature of the transaction which I'm going to enter into with my holding company is concerned. So if the my profitability is more than the profitability of my competition, then this transaction can be termed as on arm's length basis. So in intra-group companies, these difficulties arise because sometimes you don't go for bidding process, you don't take, the market prices, etc. You provide intra-group services. So in that case, the overall profitability is seen, and if that overall profitability is more than the profitability of your competition, then these transactions can be taken as on arm's length.
Okay, sir. Moving to next question. Can we take omnibus approval during mid of the year?
Yes, you can take. It is not required to be taken at the start of the year because you never know, which kinds of transactions will come. You can take the approval for 6 months, 3 months, etc. But for that financial year only. This should not be beyond that financial year.
Sir, are loan given or taken to related parties be considered as a related party transaction, as it does not fall in the list of transactions specified under Section 188 of the Companies Act?
Very good question. I think I have touched upon this also. See, as far as listing regulations is concerned, it is very much there because it is a transfer of resources. So even if it is not mentioned in 188, it will be termed as RPT and we need to take the approval of the audit committee. However, in case of an unlisted company where regulation 23 is not applicable, only 188 is applicable. So if you see section 177, it indirectly actually, includes such kind of transactions. When it says that for the transactions which are not mentioned in 188 and where audit committee does not approve, the audit committee make its recommendations to the board for approval. So by implication, it says that the transactions other than transactions which are there in 188 has to be, taken to the audit committee or the board as the case may be and should be termed as related party transactions. We should take it.
So we have another 5 questions.
Yeah.
5 last questions.
Yeah.
A private company, wholly owned government company, in which one of the nominee director is also on the rolls of the government department. Any transaction with that their administrative ministry will be treated as RPT and require the approval of audit committee or board?
I think, yes, we should take.
In case of a new company or if the turnover is not there, all the RPTs will be requiring shareholder approval, sir?
In case of the new company, which is a listed company, na?
So not
But
specifically mentioned, but we can answer.
We can take both the scenarios. In case of I think listed company, this question will not arise because it needs a track record of something, 3 years, something only, then you can list your shares. However, in case of unlisted company and the turnover is not there, then there is no concept of turnover as such in the Companies Act. Because it talks about, the arm's length perspective. And if it is not on arm's length, only then Rule 15 is applicable. I think he's correct who has, they asked this question. If it's a new company and the turnover is not there, I think we should then take whatever the turnover is there for 3 months, etc. Then on the basis of that, if it is, exceeding the amount which is in Rule 15, then we should take the approval of the shareholders. Otherwise, it is not required.
Okay, sir. Sir, if we do any transactions with a related party prior to becoming a related party, and the transaction amount due needs to be paid after becoming a related party, will that constitute as a related party transaction and that payment falls under the limits of transaction approval taken?
I think it should not be, included in that. However, for a better governance point of view, we should inform to the audit committee at least for this.
Yes. When transaction is in ordinary course of business and at arm's length with a related party, then whether AOC2 is required to be attached with board's report and filed with AOC4?
See, AOC2 talks about not only for the transactions which are not on arm's length, but the part B of AOC2 talks about the material transactions also, which are not on arm's length. So if the transaction which they are referring to is material, the answer is yes, it has to be mentioned in AOC2. And then I think, but now as far as the new circular by MCA, EAOC2 has been replaced with AOC2, and that EAOC2, I'm not sure, but my team was telling that it is not required to be filed with MCA. So the answer to these questions is the part 1, yes, material transactions are to be disclosed in AOC2. However, EAOC2 is not required to be filed with AOC4, but they can check it.
So last question. Can the board of director give omnibus approval if there is no audit committee in the company?
You see, if the audit committee is not there, then there should be some governance body to look into whether, how the transactions are being taken care of as far as the related party transactions are concerned. Even there are companies who are taking the third party, the opinion, whether these transactions are on arm's length or not. So in the absence of the audit committee, yes, my answer would be yes to this. We should take it to the board and take their approval for these transactions, because there should be some body to approve this. How will we mention in the auditor's report or in the balance sheet that these transactions were on arm's length or not? Somebody should be there.
Thank you, sir. So question answer session comes to an end.
Thank you.
So would like to extend vote of thanks. Thank you, Sanjeev sir, for sharing your extensive knowledge on related party transactions with us. The coverage of this session on RPTs, including provisions of Companies Act, SEBI regulation, RPT industry standards, along with practical aspect thereof, is definitely going to benefit the members during their professional engagements. Thank you, sir.
Thank you, Kushal. And one request, whatever the questions I could not answer, you can just share with me, because there were some problems. Let me also go through it. It will actually enhance my knowledge also. And if the need arises, then I can answer those questions also.
We'll definitely share, sir. Thank you.
Thank you. Thank you so much. Thanks a lot.